Hi, I am Soumya Jain. Welcome to Weekly Economic Insights, where we discuss the latest news and updates that affect your personal finances. In today's segments, we'll begin with an expert's view on the Income Tax Act review. CBDT Chairman Ravi Agrawal has confirmed that the comprehensive review of the Income Tax Act of 1961 will be completed within the 6-month time frame set by the Finance Minister Nirmala Sitharaman. The review aims to simplify direct tax laws, reduce litigations, and provide greater tax certainty. Let's hear what our expert CA Arvind Rao, founder of Arvind Rao Associates, has to say.
So I'm very happy to hear that the whole new revamp of the income tax is very soon coming upon us. And if you jog down the memory lane, actually, it's the new tax act is something that has been talked about right from around 2009, when there was a proposal to have a direct tax code bill 2010. Since then, a lot of things have been talked about, and every time a new act has been proposed. But I guess finally we are at that phase where we would see it happening over the next 6 months. So definitely, when we speak of from the Indian tax landscape perspective, definitely a lot of things have been changing. A lot of litigative elements that the government has been trying to remove and rationalize. So my guess is that with the new act, a lot of these gray areas and rationalizations will come to the fore, and the new act will be maybe a little simpler and easy to understand as well. One. And on the other end of the spectrum, when we talk about the personal tax laws, then I think the biggest draw that this new act will get into is the new regime. Like the current act, because it has been having these old tax rates for a long time, you have this old regime and the new regime. And the last budget that happened, the FM was very clear in her speech saying that they have seen around 72% of people have opted for the new regime. So this new act is definitely going to consolidate and I guess abolish the old regime totally and bring out a new sleek income tax act without any deductions and maybe better slabs, which will be hopefully more useful for people, specifically those who have been opting the new tax regime in the last 2-3 years. And last point, I would like to mention that a lot of tweaks and rejigs have been done when it comes to rationalization and simplification of the various capital gain taxation as well. So my bet is that in the new tax law that comes into play, you'll see the final avatar of the various rationalization of the capital gains as well that happened in the last budget. So I look forward to the new act, and it's going to be a new law for everyone here. Thank you.
Thank you for sharing your thoughts. Now let's look at a major trend in the banking sector. Indian banks have significantly increased their borrowings through market instruments. As of July 26, 2024, scheduled commercial banks reported borrowing of 9.32 trillion rupees. This represents a 19% year-on-year increase and a 20% rise since April. The surge in borrowings is due to a gap between credit growth and deposit growth. Banks are using various short-term funding methods, including intra-bank repo operations and infrastructure bond issuance. The Reserve Bank of India governor has expressed concern about this trend, warning of potential structural liquidity issues in the banking system. Increased borrowing could lead to higher interest rates, potentially benefiting investors through better saving and fixed deposit returns. Shifting our focus to deposit protection, RBI Deputy Governor M. Rajeshwar Rao has proposed increasing the current 5 lakh rupee limit on deposit insurance coverage for bank accounts. He suggests periodic revision to this limit, citing India's economic growth and increased bank deposit. The current system completely covers 97.8% of bank accounts, higher than the global average of 80%. Rao suggested adding digital deposit products to this coverage. He emphasized that while full insurance for all depositors isn't possible, protecting small and senior citizens should be prioritized. If implemented, higher deposit insurance would provide greater security for investors saving and potentially encourage more people to use formal banking services. Moving on to an important warning for taxpayers. The Income Tax Department has issued an urgent advisory warning taxpayers about fraudulent schemes involving fake tax refund claims. Cyber criminals are sending fake emails, messages, and pop-up notifications claiming approved tax refunds. These scams often target innocent people and request sensitive information like credit card numbers or bank account details. The department clarified that it never asked for such details via email or message. Taxpayers are urged to verify refund status only through official channels and to report suspicious communications to specific email addresses provided by the department. This warning helps investors protect their financial information and avoid scams, promoting a safer environment for managing taxes and investments. Let's move on to new rules for fixed deposits. The Reserve Bank of India has announced changes to regulations governing fixed deposits with non-banking financial companies and housing finance companies effective from January 1st, 2025. Key changes include allowing full premature withdrawal without interest for small deposits under 10,000 rupees within 3 months. Up to 50% of 5 lakh rupees can be withdrawn prematurely for other deposits. In cases of critical illness, 100% premature withdrawal is allowed without interest. NBFCs must now inform depositors about maturity details 14 days before the due date, reduced from the previous 2 months requirement. These new rules provide more flexibility and options for investors with fixed deposits in NBFCs, potentially making these investments more attractive. Finally, let us quickly look at the bank's credit growth. The Reserve Bank of India's latest data reveals a growing gap between credit growth and deposit expansion in the banking sector. As of July 26, 2024, bank credit growth stood at 13.7% year-on-year, while deposits grew at a slower 10.6%. When accounting for the HDFC's merger, these figures rise to 15.1% and 11% respectively. Credit offtake reached Rs 168.1 lakh crore, a 5.3% increase from December 2023, driven by personal loans and MSME lending. Deposits grew by 5.5%, reaching Rs 211.9 lakh crore, supported mainly by the time deposits. To bridge this gap, banks are increasing using certificate of deposits, but at higher cost. The credit deposit ratio, a key health indicator, stands at 79.3%. This trend could lead to tighter loan availability and potentially higher interest rates for borrowers. That's a wrap for this week's Economic Insights. We've explored major shifts across various sectors, reminding us just how dynamic the financial landscape can be. Stay informed to navigate these changes and make informed decisions about your financial future.